I've been investing for over 70 years now. I've witnessed 14 recessions, maybe 15 if you count them all differently. And I'm going to tell you something that might surprise you. Every single one of those downturns made me wealthier, not poorer. Now, that's not because I'm smarter than everyone else. It's because I've learned a few principles that work regardless of what the economy throws at you. The truth is, most people get recessions completely backwards. They think a recession is the time to pull back, to hide under the covers, to wait for the storm to pass. But here's what 70 years of investing has taught me: recessions aren't disasters. They're clearance sales for great businesses. And if you know what you're doing, they're the best time to build wealth. Let me take you back to September 2008. The financial system was collapsing. Lehman Brothers had just gone bankrupt. Bear Stearns was gone. AIG was on life support. Every channel, every newspaper, every conversation was about the end of the financial world as we knew it. People were terrified. Smart people, experienced investors, they were all running for the exits. And what did I do? I invested $5 billion in Goldman Sachs, right in the middle of the crisis. September 23rd, 2008, 2 days after Goldman became a bank holding company. People thought I was crazy. Maybe I was. But I saw something different. I saw fear, massive, overwhelming fear. And I've always believed in one simple principle: be fearful when others are greedy, and be greedy when others are fearful. That Goldman investment, I structured it to pay me a 10% annual dividend on preferred shares. Plus, I got warrants to buy more stock at $115 per share. By 2011, when Goldman bought back those preferred shares, I had made $1.75 billion just from that piece. The warrants eventually brought in another billion or so. All told, that single crisis investment generated over $3 billion in profits. Not because I got lucky, because I was prepared and I acted when everyone else was paralyzed. I did the same with General Electric. Same with Bank of America years later in 2011, when I put another $5 billion in during the European debt crisis. These weren't gambles. These were calculated decisions made possible by one thing: preparation. So today, I want to walk you through exactly how I prepare for recessions. Not theory, not philosophy, the actual practical steps I take. And here's what's important: you don't need billions of dollars to apply these principles. You just need discipline. First, build your cash reserves before the storm. Right now, as I speak to you, Berkshire Hathaway is sitting on $30 to $34 billion in cash and short-term investments. That's the most cash we've ever held in our history. People criticize me for this. Warren, you're sitting on all this cash while the market goes up. You're missing out. But I'm not missing out. I'm preparing. See, cash is ammunition. During normal times, yes, you want to be invested. Your money should be working for you. But when you see storm clouds gathering, when valuations get stretched, when everyone else is euphoric, that's when you start building cash. Not all your money, but enough so that when the inevitable downturn comes, you can act. I've been doing this for decades. In 2000, before the dot-com crash, we were holding large cash balances. People said I didn't understand the new economy. In 2007, before the financial crisis, same thing. We had tens of billions in cash. And when those markets crashed, we had the dry powder to invest when everyone else was forced to sell. How much cash should you hold? Well, that depends on your situation. But at a minimum, you need 6 months of living expenses in cash. That's your security blanket. That ensures that if you lose your job during a recession, you're not forced to sell your investments at the worst possible time. Beyond that, for investing purposes, I'd say keep 10 to 20% of your investment portfolio in cash as you see a recession approaching. That way, when stocks fall 30%, 40%, 50%, you're ready to buy. And here's something important: most of my cash right now is in treasury bills. Why? Because they're paying around 5%. That's essentially a risk-free return guaranteed by the US government. In 2024 alone, our treasury bills are on track to generate about $12 billion in interest income. So my cash isn't just sitting there doing nothing. It's earning a decent return while I wait for better opportunities. People say, but Warren, treasury returns are lower than stocks. Yes, they are over the long term. But right now I can get 5% with zero risk, or I can buy stocks that I think are overvalued and take on significant downside risk. That's an easy choice for me. I'll wait. Second, make your shopping list now. Here's a mistake I see constantly: people wait until the recession hits to figure out what they want to buy. By then, it's too late. Your emotions are running high. Fear is everywhere. The news is terrible. You can't think straight. So you make your shopping list now, before the crisis. When you're calm and rational, you identify 10, 15, maybe 20 companies that you'd love to own if only the price was right. You study these businesses. You understand their competitive advantages, their management teams, their balance sheets, their earning power. For me, it's always been about quality. I'm not interested in buying garbage just because it's cheap. A bad business is a bad business at any price. What I want are great businesses at temporarily depressed prices. Let me give you an example. American Express, 1963. There was something called the salad oil scandal. Sounds ridiculous now, but it nearly destroyed American Express. A subsidiary had guaranteed loans that went bad. The stock plummeted from around 65 to 35. Everyone was panicking. But I knew American Express. I'd studied the business. I knew their charge card was beloved by customers. I knew the scandal had nothing to do with the core business. The brand was intact. The business model was intact. Only the stock price was damaged. So I put 40% of my partnership's capital into American Express at those depressed prices. People thought I was insane. Warren, the company might go bankrupt. But I had done my homework. I knew what I owned. And that investment made me multiple times my money over the years. I held that stock for decades. It's made Berkshire hundreds of millions of dollars. That's what I mean by having a shopping list. When American Express fell, I didn't need to research it. I already knew it inside and out. I just had to execute. So right now, make your list. What companies would you love to own? Maybe it's Apple. Maybe it's Johnson & Johnson. Maybe it's Visa or MasterCard. Whatever it is, study those businesses now. Know them intimately. So when they go on sale during the next recession, you're ready to pounce. Third, never ever use leverage. This is non-negotiable. I've seen more people destroyed by borrowed money than by anything else in investing. Leverage is financial poison during recessions. Here's what happens: you borrow money to invest. Maybe you use margin. Maybe you take out a loan. Stocks are going up, so it feels safe. You're making 20%, 30% returns. You feel like a genius. But then the recession hits. Stocks fall 40%. Suddenly you get a margin call. Your lender wants their money back. You're forced to sell at the absolute worst time, at the bottom, and you lose everything. I've never used significant leverage in my personal investing. Never. Berkshire uses very little debt. And when we do borrow, it's at very favorable rates, and we can always pay it back without selling assets. Let me tell you about long-term capital management. This was 1998. A hedge fund run by some of the smartest people on Wall Street. Nobel Prize winners were on their team. They built sophisticated mathematical models, and they used massive leverage, borrowing 30, 40, even 100 times their capital. When the Russian debt crisis hit and their models failed, they nearly brought down the entire global financial system. The Federal Reserve had to orchestrate a bailout. These were brilliant people, but leverage killed them. Because here's the thing: investing is supposed to compound wealth over time, but leverage can wipe you out in a single event. And if you're wiped out, the game is over. You can't compound anymore. So rule number one: only invest money you won't need for at least 5 years, preferably 10. That way, when the recession comes, you can hold on. You don't have to sell. You can wait for the recovery, and the recovery always comes. Fourth, understand the power of compounding. People always want to know the secret to my success. They expect some complex formula, some hidden strategy, but it's not complicated. It's compounding. That's it. It's letting your money grow year after year, decade after decade, without interruption. I started seriously investing when I was 11 years old. I bought my first stock then. I'm 94 now. That's 83 years of compounding. If I had started at 30, I'd have half the wealth I have today. If I'd started at 40, I'd have 1/4 the wealth. Compounding is everything. And here's what kills compounding: panic selling during recessions. Interrupting the process. I bought Coca-Cola in 1988. Since then, we've had multiple recessions. The dot-com bubble, the financial crisis, the pandemic. Did I sell during any of those? No, because I bought Coca-Cola for the business, not for the stock price. I bought it because people will still drink Coke during recessions. The brand is strong. The business model works. And today, that Coca-Cola investment is worth many times what I paid. Not because I was brilliant, because I didn't panic. I let compounding do its work. I want you to think about stocks differently. You're not buying pieces of paper. You're not buying ticker symbols. You're buying pieces of businesses. And if they're good businesses, temporary setbacks don't matter. A recession is just a drought on your farm. The farm is still valuable. It will produce again. You just have to wait. My teacher, Ben Graham, used to say, the stock market is a voting machine in the short run, but a weighing machine in the long run. In the short term, prices are driven by emotion, fear, greed, panic, euphoria. But over the long term, prices reflect the actual value of the business, the earnings, the cash flows, the fundamentals. So focus on the weighing machine, focus on owning good businesses, and let time do its work. Fifth, live below your means. This might be the most important lesson of all. If you're living paycheck to paycheck, if you're spending everything you earn, you can't save, you can't invest, you can't prepare. And when the recession comes, you're vulnerable. I've lived in the same house since 1958. It's a nice house, but it's not a mansion. It's worth maybe $650, and I could afford any house in the world. But I don't need it. I drive a regular car. I don't own a yacht. I don't collect expensive art, not because I'm cheap, because those things don't make me happy. What makes me happy is security, financial security, the knowledge that no matter what happens in the economy, no matter what crisis hits, I'm going to be okay. My family is going to be okay. And that comes from living below your means, from saving more than you spend, from investing the difference. I've known so many high earners over the years, doctors making $500,000 a year, lawyers making $700,000, executives making millions, and they have nothing saved, nothing, because they spend it all. They live right up to their income, sometimes beyond it with debt. And when they lose their job during a recession, they're in crisis within months. Don't be that person. Live like you make half what you actually earn. Save and invest the rest. That's how you build the cash reserves I talked about earlier. That's how you prepare for recessions. That's how you build real wealth. And here's the thing about lifestyle inflation, it's a trap. You get a raise, you get a promotion, and immediately you upgrade your lifestyle. Bigger house, nicer car, more expensive vacations. And you're not saving any more than you were before. You're just spending more. The smart play is to keep your lifestyle constant and save the difference. That's how you build wealth. That's how you get financial independence. That's how you sleep well at night. Sixth, focus on balance sheets. During a recession, companies with a lot of debt get into trouble. They can't make their payments. They go bankrupt. Shareholders get wiped out. So you want companies with strong balance sheets, low debt, lots of cash, solid credit ratings. I can't tell you how many times I've watched investors buy a stock because it looked cheap, only to see it go to zero because the company couldn't survive the recession. It's not enough for a business to be good. It has to be financially strong. When I invested in Goldman Sachs in 2008, I checked their balance sheet carefully. Yes, they were under pressure. Yes, their stock was down. But they had capital, they had liquidity. I knew they'd survive. Some banks didn't. Washington Mutual failed. Wachovia had to be rescued. But the strong banks like Goldman and JP Morgan came out even stronger. So when you're making your shopping list, one of the first things you check is the balance sheet. How much debt does the company have? What's their debt to equity ratio? Can they service their debt even if revenues fall 30%? If the answer is no, move on. Find a different company. Because here's what happens in a recession. Weak companies don't just struggle. They disappear. And strong companies take their market share. They get stronger. That's why you want to own the survivors. Seventh, think in decades, not days. I'm often asked about market timing. Warren, when should I buy? When should I sell? And my answer is always the same if you're trying to time the market. You've already lost. I don't try to time recessions. I can't tell you when the next recession will start. I can't tell you when it will end. What I can tell you is that over the last 200 years, the U.S. economy has grown consistently. There have been recessions along the way, but the long-term trend is always up. So if you think in decades, recessions become noise. They're just temporary interruptions in a long upward journey. I bought stocks that went down 50% the next year. Doesn't matter. If I hold for 20 years, that 1 year decline is irrelevant. The key is to not try to be perfect. Don't try to buy at the exact bottom. You can't. Nobody can. What you can do is start buying when stocks are clearly cheap. When fear is high, when everyone's panicking, buy some. Then if they go down more, buy more. Average in. Over time, you do very well. Eighth, study history. Every recession is different, but they all rhyme. Different causes, different severity, different duration. But there are patterns. There are lessons. The Great Depression taught us about deflation and the importance of government intervention. The 1970s taught us about stagflation and the danger of holding cash during high inflation. The 2008 crisis taught us about leverage and systemic risk. The 2020 pandemic taught us about the speed of modern policy response. Each recession has something to teach you, so study them, read about them, understand what worked and what didn't. Because while history doesn't repeat exactly, it does rhyme. And those lessons will help you navigate the next downturn. Ninth, have the courage to act. This is where most people fail. They have the knowledge. They have the strategy. They have the cash. But when the moment comes, when stocks are falling and everyone's scared, they freeze. They can't pull the trigger. I felt that fear too. In 2008, when I was writing that $5 billion check to Goldman Sachs, part of me wondered if I was making a mistake. The entire financial system looked like it might collapse. But I had done my homework. I had a plan. And I trusted that plan more than I trusted my fear. The way to build that courage is to prepare mentally beforehand. Visualize the recession. Imagine stocks falling. Imagine the fear. And imagine yourself staying calm and executing your plan. Practice it in your mind over and over. So when it actually happens, it's not new. You've already been there mentally. That's the difference between people who get rich during recessions and people who just watch it happen. Courage. The courage to act when everyone else is paralyzed. 10th, be patient. This is the hardest part, patience. When you buy stocks during a recession, they don't go straight up. They bounce around. They might go down more before they go up. And that tests your patience. That tests your resolve. But if you've done your homework, if you bought good businesses at fair prices, you just have to wait. Think of it like planting an oak tree. You plant the acorn, you water it, you protect it. But you don't dig it up every week to check if it's growing. You just let it grow. And years later, you have a mighty oak. That's investing during a recession. You plant your seeds, you protect them, and you wait. And if you can do that, you'll be rewarded. The current situation now, let me talk about where we are today. As of the end of 2024, I've been selling stocks and building cash. We sold over 600 million shares of Apple last year, reducing our stake by 67%. We've been trimming Bank of America. We've been net sellers for 10 consecutive quarters. Why not? Because I think these are bad businesses. Apple is probably the best business I know, but valuations got stretched. The market got euphoric about AI. Stock prices disconnected from underlying fundamentals. And when I can't find businesses at reasonable prices, I hold cash. Some people think this means I'm predicting a crash. I'm not. I've said it before. I've never successfully predicted economic forecasts in 60 years at Berkshire. But I don't need to predict the future to prepare for it. I just need to be ready for anything. And right now, with $334 billion in cash earning 5% in treasury bills, I'm ready. If the market keeps going up, fine. My existing holdings will do well. But if we get a recession, if we get a real correction, I'll have the ammunition to buy great businesses at fair prices. That's the strategy. That's how I've done it for 70 years. And that's how you can do it too. Bringing it all together. Look, recessions are coming. I don't know when. Could be next year. Could be 5 years from now. But they're coming. That's certain. And when they do, you have a choice. You can panic. You can sell. You can run for the exits like everyone else. And you'll probably lose money, miss the recovery, and regret it later. Or you can prepare. You can follow these principles. You can see the recession for what it really is, an opportunity. Build your cash reserves now. Make your shopping list of great businesses. Strengthen your balance sheet. Avoid leverage. Live below your means. Think long term. Study history. And when the recession comes, have the courage to act. Do those things, and the next recession won't be a disaster. It'll be the best investment opportunity of your lifetime. I'm 94 years old now. I won't be around for many more recessions, but you will. You've got decades ahead of you, decades of cycles, decades of opportunities. And if you apply these principles, if you learn to be greedy when others are fearful, those decades will make you wealthy beyond what you can imagine today. Not because you're smarter than everyone else, but because you're more disciplined, more patient, more prepared. That's the real secret. It's not complicated, but it works. It's worked for me for 7 decades, and it'll work for you too. Thank you.